It's almost 1 p.m. in Sydney, 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks treading water on fresh signs of slack in China. We're now hearing Beijing will start selling $138 billion in ultra-long bonds on Friday. Trade tensions also hurting sentiment. President Biden set to quadruple some tariffs on Chinese goods this week. Plus, Australia's budget on Tuesday. It's set to predict inflation returning to target by year end. Our interview with Treasurer Jim Chalmers is coming up. All right, well, let's take a look at how we are faring on markets. We're going kind of sideways at the moment. Avril Hong's here with a closer look. Avril.
Yeah, Paul, we're seeing the negative territory in some of these stock benchmarks. A couple of things happening here. I mean, we had China data on the credit front raising some concerns about how it still looks pretty soft. Even on PPI that was out previously, we showed that deeper contraction, and all this being wrapped up along with concerns about how the Biden administration might be quadrupling tariffs on some Chinese goods. And then along with that, don't forget, we also had U.S. data showing consumer sentiment declining, rising inflation expectations based on one survey at least. Of course, we'll be keeping an eye on the US CPI numbers later in the week. So for now, Asia stocks are, as you mentioned earlier, treading water, although we're seeing a slight bump up on the Hang Seng. CSI 300 is flat, keeping an eye on the offshore yuan as well as it moves towards the 724, and keeping an eye as well on the Japanese currency along with JGBs. We got the BOJ in today's purchase reducing the number of bonds for 5 to 10 year, and this is, some say, perhaps a test balloon for scaling back of its bond purchases. Let's look at the board and take a look at the data out of China. Aggregate financing, this is a broad measure of credit, and it's declined for the first time since 2017. So this was when the data first started being tracked. The concern here is, despite the PBOC's ample liquidity, that the households, the firms, they're not biting, adding to the list of concerns related to China, Paul.
All right, thanks very much, Avril. Staying on China, Bloomberg's learned that Beijing plans to start the sale of 1 trillion yuan in ultra-long special central government bonds. That'll begin on Friday. Economist David Chu joins us now with more. So, David, $140 billion, a trillion yuan, sounds much cooler in yuan. What's the money going to be used for, and is the demand there to soak this up?
Yeah, according to the statement from the government, the money will mainly be used for some key areas in the economy, such as the agricultural side and also the areas for the long-term sustainable growth of the economy. So that is what we got so far, but we didn't have more details on that.
Well, let's take a look at some of the data that we had out of China on the weekend. PPI looking pretty weak, CPI staging somewhat of a tepid recovery. Are we at the stage yet where this warrants a policy response from the PBOC?
Yeah, we have been calling for the PBOC to do more rate cut in this year because of the softer inflation reading. What we are worried more about the inflation is the PPI, because the PPI has been in negative for, in my mind, is 19 months in a row. So that would be a drag to profit, to companies' profits. So that is the reason why we think the PBOC should do a rate cut. But obviously, the PBOC is some kind of concern of the renminbi exchange rate, so that we think it can still cut rate, but it should be in June. That is our base case. And but to be honest, we with the credit data announced in the weekend, we now think the cut in May is of higher chance now.
Yeah, China's facing some external pressures as well. Let's talk about tariffs and how President Biden has a plan to raise levies on EVs. How might that impact China's economy?
Well, our assessment is that the proposed tariff, it has limited impact to China's economy. That is because that the export of EV from China to the U.S. is a very small share compared to the total export package and also China's economy. And but definitely it will have some impact, and to the extreme case, it can drag the growth by 1 percentage point. But on the other hand, we think that as I said, it's a very extreme case, and we think that for the most of the case, the impact should be in the longer term because it demonstrates the U.S. Tough attitude toward China export.
Now, David, your team there at Bloomberg Economics has got a new report out as well. It's a deep dive on China's economic challenges, and a lengthy read it is as well. Can you walk us through some of the key points?
Well, I think for the recent, for the near term, we think that the key is still to boost the economy's confidence. And we have seen that the PBOC took a lot of effort on this to boost the credit growth. But as I said, the confident thing, we cannot rely on the PBOC only to boost the confidence. I think now the ball is more at the side of the government. They need to do more. And we think that the 1 trillion yuan ultra-long bond could be a way to help. But we think it needs more actions, more than that.
All right, Bloomberg economist David Chu there in Hong Kong. And subscribers can read more of that Bloomberg Intelligence deep dive into China's economy on the Bloomberg terminal. Now let's take a quick look at the week ahead, and it's going to be a big week for the global economy. Key data coming out from the US and China, and Bloomberg Economics expects April's US CPI and PPI numbers to show a marginal improvement from March. They also see core CPI moderating and the headline figure rising due to higher gasoline and food prices. Here in Asia, meanwhile, China is going to be releasing more economic data on Friday, and that's set to show a production-led rebound. And the PBOC also expected to keep its one-year MLF rate unchanged on Wednesday to avoid further yuan weakness. All right, let's get a bit more on markets now. Bring in our first guest who thinks the dollar's going to stay strong, and she only expects 1 rate cut from the Fed this year. Joey Chu is head of Asia FX research at HSBC, joins us now from Singapore. Joey, thanks so much for joining us. I'll get to your calls on the Fed in a minute, but I just want to pick up on what David there was saying about China. And in the light of those weak PPI numbers and sort of tepid CPI numbers we had as well over the weekend, David thinks that this invites a policy response from the PBOC. Are you expecting anything meaningful in that regard?
Yeah, I mean, I think our sense is that, PBOC has been keeping the currency very stable against expectations, against the external challenges all through April. So it seems like the tolerance level for, be it domestic issues or even external issues like yen undervaluation is very, very high. So we don't think that, the recent data points itself will trigger necessarily an immediate change in policy.
We've had a lot of, our charts team has been very busy with China today. A lot of data out that we've been illustrating, including seeing China's having its first credit extension drop since 2005. We've also seen government borrowing fall. Demand for mortgages is very low as well. What can shake the animal spirits out of hibernation?
Well, I think definitely more, government policies, government vision for the longer-term growth prospects, I think, are very important. And for this, I think we have to look forward to the third plenum, possibly in the month of July, for some of this, more medium-term directions.
I just want to talk about the direction of the yuan as well. It's weakened about 1.5% this year, the offshore yuan. How much more depreciation do you expect to see, or how much more might be tolerated?
Well, to be frank, actually, the depreciation pressures has been immense. And so the actual depreciation that has materialized is actually quite small. So this goes to show that the currency stability is a very important policy focus for the PBOC. So to the extent that we get more of the same for the rest of this year, I think they will continue to keep the currency stable. The risk, however, is that geopolitical tensions become a much bigger risk in the second half of the year, right? We're really getting a flavor of that with the tariffs coming from this week. But I think the broader test is that if we have broad-based tariffs, like what we had in 2018, list 1, list 2, list 3, those will be the one that I think could potentially shake the RMB out of its current stability mode.
Yeah, it's not just potential tariffs from the US as well, but it's what's going on in the broader macro picture there, and particularly in terms of inflation. I mean, we've seen super core inflation remaining very sticky. We're going to get US and CPI numbers in just a couple of days' time. What are your expectations around that read? Do you think there's another chance here of an upside surprise?
The thing about inflation in the U.S. is that it's been surprising on the upside for 3 times in a row. And so expectations in the market, consensus, are really adjusted higher, right? So our economists are expecting about 0.34% month-on-month this month. And I think that's reflected in the market expectations already. So the bar is getting higher for U.S. inflation data to keep beating. But that does not mean that the dollar will necessarily soften, because at the end of the day, objectively, inflation is still at a high level, even if it's not surprising anymore on the upside.
Yeah, that suggests that the Fed is going to be higher for longer, and I guess the question is how high, how long. I know you've still got 1 rate cut in your forecast, but is there a non-zero chance that the next move from the Fed could be tightening?
Yeah, that is true. So we have to, indeed investigated what are the potential implications for the dollar if the Fed actually forgets about cutting and actually does a hike. Now, for what it's worth, Powell actually dismissed that possibility already, right? And that actually caused the dollar to soften a bit. So if that possibility was to come back, then obviously the dollar will strengthen again. And obviously it will be at the peril of low-yielding currencies in Asia, which are already, having this significant interest rate differential with the U.S.
Yeah, in terms of that, I give you Exhibit A, the yen, which is weakening again, 155.76. Do you see that sliding much further? And not that the Ministry of Finance has said that it's intervened, but do you think we might see some more policy to support the yen?
Interest rate differential is definitely to the disadvantage of Japan, and we have seen in history, in the historical intervention episodes, that a couple of things are necessary for intervention to be sustainably effective. One is that the BOJ probably needs to hike rate as well, and actually a good thing is that we are expecting the BOJ to do another rate hike in the 3rd quarter of this year. The other thing that is also very important historically is that the Fed needs to cut, and then the third thing is that we need to get some kind of verbal endorsement from U.S. Treasury or U.S. Officials. We already had a soft version of that, but I think maybe market is expecting a more ringing endorsement in that form.
Are there any EM currencies out there that are looking undervalued to you at the moment?
Frankly speaking, the most undervalued currency in the world is yen. Second to that, I think there are some in Asia also looking a little bit on the low side of the valuation. For example, the Korean won, the ringgit, Taiwan dollar. But a lot of these currencies have been undervalued for a long time, just like the yen. So at the end of the day, valuation cannot direct us to the direction of the currency. We still need some policies to fall into place, namely the Fed's monetary policy.
You mentioned geopolitics a bit earlier as a key risk there. Are there any other risk factors you're watching at the moment?
Well, we already talked about some of the risks that we're watching out for. For example, the potential for Fed to hike rates, geopolitical tensions. I think the third thing is that, geopolitical tensions in the Middle East to bring back the kind of oil price increases to further, raise the risk of stagflation in the economy, in the global economy. That is also a potential risk to think about.
All right, Joey Chu, Head of Asia FX Research at HSBC. Thanks so much for joining us today. Still to come this hour, we're going to be joined by the president of India's largest engineering and construction firm, L&T, and we're going to discuss what's next for the company after it reported a fourth quarter profit beat. Also, we're going to discuss the West's efforts for chip supremacy over China. A big take discussion just ahead. This is Bloomberg. Let's take a look at some of our top geopolitical stories. Russian President Vladimir Putin has replaced his long-serving defense minister in a surprise move. Sergei Shoigu had been in the post since 2012. The reshuffle is the first major shake-up of the Kremlin's military leadership since the Ukraine invasion, and it comes as Russian forces seek to capitalize on a battlefield advantage in the war. The US says Israel risks fueling a post-war insurgency in Gaza, with thousands of armed militants remaining in the territory, even if Israeli forces invade Rafah. Israel says it now has evacuated the eastern third of the city as it prepares to expand its military operation. Last week, the US said it would withhold weapons that may be used in Rafah and cited evidence that Israel had breached international laws protecting civilians. Well, Australia's government is set to release its annual budget on Tuesday, and there's potentially some good news on inflation. So for more on this, let's bring in our Australia government reporter, Ben Westcott, here in Sydney. And Ben, thanks for joining us. And
good to be here, Paul.
You had the pleasure of sitting down with the Treasurer on Sunday morning.
I did indeed, yes.
What did he tell us?
So he told us that we should expect more in this budget for critical minerals than's already been announced. There's been about $500 million in exploration for general resources, but with a specific focus on critical minerals. So he told us there'll be more in the budget for that. And he also told us that he's not backing down on his RBA legislation, which will split the single board into two boards, governance and monetary policy. So there's about three things now we don't know left from the budget. We don't know whether the government's going to have a second consecutive surplus, although we suspect they probably will. We don't know exactly what the future Made in Australia industrial policy will look like. And finally, we don't know exactly what the subsidies for households in terms of energy and rent will look like. But we covered all of this with the Treasurer, who I spoke to just on the weekend.
I think we've got to strike a finer balance in this budget between the near term and the longer term. Also making sure we can provide that cost of living relief for people who are doing it really tough at the moment, at the same time as we invest in a future made in Australia. So it'll be a responsible budget. It will ease cost of living pressures, but it will also invest in the future. And obviously, forecasting inflation at the moment is tricky. It's tricky at the best of times. But what the budget will do is it will put downward pressure on inflation rather than upward pressure on inflation. Yeah, we've made substantial progress here in Australia in the fight against inflation, but it's not mission accomplished because people are still doing it tough. And so the budget will be very focused on that.
Obviously, over the past six months or so since you've been putting this budget together, the outlook for inflation has changed quite a lot. Has that changed your thinking on the way you've put the budget together?
We're making that progress in the fight against inflation. We know that it needs to be the primary focus, particularly at the front end of the budget. And that's why you'll see substantial spending restraint. You'll see our cost of living measures designed in a way that takes the edge off inflation rather than adds to inflation, so that overall our budget will be part of the solution to inflation rather than part of the problem.
Now, moving on to a future made in Australia, that's going to be a big part of this budget. How does the future made in Australia, how does that differ from the IRA in the United States?
Yeah, what we're trying to do here is to make sure that Australia grabs the vast economic and industrial opportunities from the global shift to net zero. And the sorts of things that we are contemplating are not out of place, whether it's in the United States or indeed in most of the developed world. But for Australia, we've got some huge advantages. You know, we've been dealt some incredible cards. Our resources base, our industrial base, energy, our human capital base, our attractiveness as an investment destination. And so what a future made in Australia is all about is not replacing private investment in the opportunities of the future, but attracting more of it. That will require some public investment, and we need to make sure we get value for money for that. We've got our own unique set of advantages as the economy changes, the global economy, and the pace of that change accelerates. We want to make the most of it. We want to create good, secure, well-paid jobs and prosperity into the future. And that requires us to renew and broaden and deepen our industrial base.
But you mentioned obviously Australia's unique advantages, but isn't Australia coming too late to this? I mean, a lot of the people we'll be competing against, a lot of the other countries, our partners, have had these policies in place for quite some time.
Well, we better get cracking then, and we will on Tuesday. We have made substantial investments already in our ambitions to become a renewable energy superpower, which is really at the core of a future made in Australia. The global economy of the future will be powered by cleaner and cheaper energy, and we've got a big role to play in supplying that to become a reliable supplier of that energy. But there is more that needs to be done. A combination of tax incentives, targeted grants, making sure that we've got the architecture to attract and absorb and deploy all of this private investment. You'll see a lot of that on Tuesday night.
Now, on to critical minerals, which is part of this. You've announced $500 million so far for exploration for critical minerals. Is that all that we're expecting for critical minerals in this budget, or should we expect more on Tuesday?
Oh, you should expect more on Tuesday. Critical minerals are the opportunity of a century for Australia. This is genuinely a golden opportunity for Australia. Our critical mineral space is one of the reasons why there is so much attention from global and domestic investors, but we need to make sure that we can attract and deploy that. The exploration is an important part of that. That geoscience, open source science to map Australia, our groundwater, our critical minerals opportunities, a big important part of it, but there'll be more.
Speaking of global opportunities, China, we're starting to see a few green shoots in their economy, but for Australia, we'd like to see a lot more, I'm sure. From your conversations around the world ahead of this budget, but ahead of the rest of the year, are you expecting to see more stimulus in the Chinese economy as the year goes forward?
I think there's certainly a prospect of that. Our budget will forecast Chinese growth with a 4 in front of it in the near term, and if that eventuates, that'll be the weakest period of growth of that length since China began opening up in the late 1970s. And so the Chinese economy has been soft. The property sector has been a big part of that, but not the only part of that. And that weakness has kind of offset in our global forecast the strength we've seen in the US.
Yeah. So that was the interview with Jim Chalmers, and there's a possibility this could be an election budget, certainly, something that he wasn't ruling out on Sunday.
Yeah, he was coy with that, wasn't he?
Definitely.
All right, Ben Westcott, our government reporter there. Okay, stay with us. We have plenty more ahead. This is Bloomberg. Just got some breaking news on the terminal, although it was kind of us that broke it a little while ago. Confirmation of this Bloomberg reporting now that China is going to sell 20-year, 30-year and 50-year special sovereign bonds. So some ultra-long dated bonds are going to be sold to the tune of $1 trillion yuan. That's $138 billion. And this is China as it seeks to raise funds to support its economy. So 20, 30, 50-year government bonds are going to be going on sale, confirming Bloomberg's earlier report. Okay, we've got China markets just heading to lunch. Let's take a look at how we're tracking with some of those benchmarks. It's a kind of a meh day, really. We've got the CSI 300 just tracking sideways at the moment. I did mention earlier that some of those China biotechnology names are doing reasonably well. We did hear the news earlier that there's going to be a US bill aimed at blocking foreign biotech companies from accessing federal contracts, but it hasn't really hurt Wuxi. It's rising at the moment because it's got an 8-year grace period to get its game wrapped around that. So some of those Chinese stocks doing pretty well. The Hang Seng Tech Index performing okay also. Got the yuan though strengthening a little against the greenback. Weakening a little against the greenback. 723.36 at the moment. But most of those indexes for equities in weaker territory. All right, let's get a bit more on markets now. Let's bring in Bloomberg MLive strategist Mark Cranfield. And Mark, I want to start on that story that we were reporting on earlier about those ultra-long bond sales in China. What is that money going to be used for specifically? And is there the demand there to soak up this debt?
Well, on the first part, I think everyone would like to know where the money is going. I don't think that's clear just yet. In terms of demand, that is certainly a very important question for investors, especially for that 50-year sector. That is the part of the curve that really gets tested. Very few governments around the world ever sell bonds as long as 50 years. So it's a little bit unknown what kind of demand you would expect. And if you look at the way the Chinese curve is currently set up, you would extrapolate and expect that the yield would probably be slightly below 3%, which doesn't sound very exciting for a very, very long duration bond. But of course, if people expect there's going to be further RRR cuts in the future from China and other forms of easing and a stable currency, then it might not look so bad. You'll probably have domestic investors, probably in the insurance sector, who need to buy very long duration bonds, and they would probably be keen on it. But of course, people will also want to see if that affects the Chinese credit rating as well. They are, in total, selling a pretty large amount of bonds here. And the rating agents are to be looking at it very carefully, particularly as China's fiscal situation has been deteriorating slightly over the past couple of years. So it's a little bit of an unknown how the market is going to receive it in total. It's good for the Chinese economy in the sense that it's clearly a term as a kind of a liquidity injection to the overall economy. But investors want to know how quickly is that money being deployed and what kind of final demand do we see, especially for the longest duration bonds.
We've also had the news, of course, today. We've been talking about the US increasing tariffs, particularly on China EVs. What's the impact of this going to be, and is it symptomatic of it being an election year in the US?
I think nobody's surprised that there's a threat of more tariffs coming between the United States and China. I think everybody who's been following the election cycle in the United States and the general news would have seen that coming. I think that's why the market hasn't been too shocked about it. If you look at what Bloomberg Economics is saying, the market would be most concerned if they go after the future generation products which China is currently trying to put together. Apparently it's a key platform of President Xi. The country has been putting money into those areas. Now, if the United States does target those, that's probably even more serious than the current round. But in terms of the market, yes, was really very well prepared. You can see the Chinese currency has weakened a bit, but not dramatically. The PBOC still has a pretty good grip on the currency. But certainly if these tariffs get even more substantial and it continues for a long time, the safety valve is a weaker Chinese currency. And that's a question that markets haven't fully addressed yet because it's been under relatively low volatility for a few weeks. But it's certainly somewhere where the PBOC could allow it to move quite a bit.
We are, of course, going to get inflation data out of the US this week, possibly the most eagerly awaited data of the week. Stocks have been performing pretty well, mainly off the back of earnings. But if this high inflation, weak growth narrative really starts to take hold, what's the future for equities?
Well, the equity market has been absorbing it pretty easily because exactly for that reason is that the inflation numbers, yes, maybe they're slightly higher, but they're not dramatic. And if you look at the overall state of the American economy, it's doing very well. The employment numbers are still very good. So you've almost got a Goldilocks scenario. In terms of equities, they're very focused on AI. They can absorb slightly higher inflation numbers as long as the job situation stays strong. So they're not too worried. It's the bond market that's most concerned. The last two inflation reports, the ones that came out in March and April, jolted the Treasury market considerably. And that was where the biggest impact, that fed also into the US dollar, which rose as well. So really it's a bigger story for currency and bond markets. Equities can probably deal with it unless it's a really shockingly high number. And that puts the Fed back in the picture for a potential rate cut, which of course Jerome Powell said he doesn't want to do. But you never know. If the inflation data is really hot, even the Fed may need to reconsider.
Mark, just want to ask you about the MLive Pulse question, or the MLive Pulse survey this week threw up a kind of an interesting result. 30% of respondents saw US tech stocks as an inflation hedge. I mean, gold's still out in front at 46%, but how do these two compare when it comes to an inflation hedge?
Well, that really is the AI narrative. There's a lot of investors there who think that the AI story is immune really to what happens in the broader economy, what happens to interest rates, wherever monetary policy happens to be going, that these companies are generating sufficient numbers and the prospects are so good for the future take-up of AI. You've got Apple again here talking about putting it on their iPhones, which is another increment in the whole story. So as long as there is tremendous interest and potential in that respect, then tech companies do look quite outstanding relative to the rest of the market. Gold, of course, is being supported by central banks, and as long as they continue to build reserves via that route, then gold will also continue to be a good outperformer.
All right, MLive strategist Mark Cranfield, thanks as always for joining us. Asia's earnings spotlight's going to shift this week to China's internet giants. Alibaba and Tencent could report single-digit revenue growth last quarter. This is according to analyst estimates. Bloomberg Intelligence is also expecting slower first-quarter ad growth for Baidu and better margins for JD.com. Now, we're also going to hear from Japan's mega banks. They could see a jump in their annual profits. And later on Monday, SoftBank will probably report trimmed losses as its vision funds return to profit. Well, let's stay on tech, and of course superpowers led by the US and the European Union have funneled nearly $81 billion into producing the next generation of semiconductors, and this escalates the global showdown with China for chip supremacy. US industrial policy reporter Mackenzie Hawkins has more on today's Big Take. So Mackenzie, truly enormous amounts of money being spent here. Can you give us a sense of the scale of the spending and how it's being deployed?
So we've got governments from Washington to Brussels to Tokyo and Seoul pouring billions and billions of dollars into semiconductor production. This is because the pandemic revealed that there was an overconcentration of supply chains, especially for the most advanced semiconductors in East Asia and particularly Taiwan. And so you had this push led by the U.S. and then quickly followed by a lot of U.S. allies to not just make sure that we have these supply chains safe at home, but also catch up to decades of industrial policy in the sector from Beijing.
So there's very long timelines involved here. It takes an awfully long time to build a chip fab. When can we expect to see all of this spending bear some fruit?
So right now we're in, what Commerce Secretary Gina Raimondo has described as the bottom of the second inning in the global race for semiconductor supremacy. The U.S. has allocated around $32 billion of a total $39 billion fund to lure chip companies to American soil. But none of that money has actually gone out the door. We only have preliminary agreements contingent on due diligence and companies hitting certain benchmarks, like actually building the facility and actually starting production. Right now, estimates show that companies are going to bring those facilities online starting in some of the earliest cases in late 2024, early 2025. You're going to see a big surge in American chip making capacity in 2027 and 2028. And the Semiconductor Industry Association predicts that by 2032, if all of these facilities actually come online as promised, you could see the U.S. taking 28% of global advanced logic semiconductor capacity. Those are the chips that serve as the brains of devices. That would make the country second to only Taiwan and up from 0% today. So it could be really a massive realignment of global semiconductor supply chains.
All right, U.S. industrial policy reporter Mackenzie Hawkins there. And subscribers can read more on today's Big Take on the terminal. NI Big Take is your function, or you can head over to Bloomberg.com. This is Bloomberg. Welcome back to Bloomberg Markets Asia. Watching the India focus. Let's check in on India's pre-market session. So we've got futures shaping up in kind of negative territory, and that's perhaps not surprising. That's very much the theme that we're seeing around the Asia Pacific today, very much a risk-off theme. We are going to get April CPI numbers out of India a little later on. We are expecting CPI in April to soften just a little, down to 4.8%. Wholesale prices expected to pick up. That's that reading coming out tomorrow to 1.1%. So keep an eye out for those April CPI numbers. So 2 minutes thereabouts until the open in India. Well, last Larsen & Toubro is India's largest engineering and construction firm, and last week it reported its highest quarterly profit in 4 years. So let's get over to Mumbai now, when Bloomberg's Menika Doshi is standing by with the company's CFO. Menika.
Hi, good morning, Paul. You're right. This is the country's largest construction and engineering firm, and hence a great barometer when it comes to public spending, infrastructure projects, which have been a big theme for India's economy over the last few years, and also potentially the return of private investment. Now, you pointed out the quarterly profit, but I should note here that its guidance for FY25, that's April to March this year, is lower than what most people expected on account of a disruption in infrastructure orders by the central government in India because of the ongoing election and the troubles that we're seeing in the West. Now, to get some more insight on how all of that will pan out through the course of the year, I'm joined by R. Shankaraman, the President and Group CFO of Larsen & Toubro. Mr. Shankaraman, good morning. Thank you for your time this morning. And let me get straight to my top question, which is that this last year you booked more than half your orders from outside India. 54% of your orders were from outside India, most of them from the Middle East, and then a sizable amount from US and Europe. Talk us through the sustainability of that for this next year.
Good morning, Menika, and good morning, viewers. I think we operate in business which has large orders per ticket. So there is every likelihood of the percentages going to some misleading directions in terms of, whether it's 54% or 43% or whatever it is. But the fact of the matter is, during the first 9 months of the year, which went by, FY24, I'm talking about the period April 23 to December 23, we did expect a larger share of orders to come through because we knew the quarter 4 of FY23-24 was always likely to be disrupted by the elections, union elections and few state elections. And so it did. And consequently, the trajectory of orders that we got in quarter 4 of the year was pointing more towards international and less towards domestic. So consequently, as a year as a whole, we had some big order wins in the Middle East, both in the space of renewable energy as well as in the space of hydrocarbon. The refreshing development insofar as Middle East is concerned, it used to be almost a single pony trick in terms of just hydrocarbon orders. But over the last few years, we see that there's been considerable broad basing of investments that's happening. Downstream industries are getting invested into. Industries which consume a lot of power for value-added products and services are being invested into. The cities are getting developed. They're connected through railway network. The Middle East is now aiming to become a tourist destination for reasons other than Dubai. So all of this means that the kingdom there is thinking about enlarging the footprint of infrastructure play, and that plays to strength of L&T. L&T, fortunately, thanks to its years and years of work in India, has acquired pre-qualification in most part of the infrastructure play. And when this gets replicated in Middle East, it does become a relatively easy pre-qualification criteria.
You expect this to continue, Mr. Shankaraman, in terms of the quantum of orders from the Middle East and also the increase we've seen in US and Europe?
The increase in US and Europe, Menika, is largely arising out of our IT services. So when we report our consolidated financials, even though these two companies are listed subsidiaries, we do have to aggregate their revenues and their results into, and hence the geographical distribution, I would like you to look at it a little differently. Just look at the projects and manufacturing business and the geography distribution. The services will continue to be US, UK, Europe heavy. Insofar as the Middle East investments are concerned, I see that the redistribution of investment priorities are beginning to happen. For example, Saudi Aramco is one of our largest customers. And there is a move, at least that's what we hear in the press, that they would like to not exceed 12 billion barrels a day of production. And at the rate at which they were moving, on their investment program, it could have well taken them to close to 15 billion barrels. So possibly there is some pause to make sure that the wealth created through oil and gas is getting redistributed. And today we see renewable energy, large investment, almost 18 gigawatts worth of renewable power projects, solar power projects. We are doing ourselves as a company.
Yeah, forgive me for interrupting you, but time is short, so I want to get in a couple of quick questions. What's the verdict on the return of private investment? Last time we spoke, which was a year ago, you said that was 32% of your manufacturing segment. Are you seeing a build-up on that? Can we sort of confidently say the private sector has come back to investment mode in India?
It's been very stable, Menaka. Just to be very brief on this, I think the sectors that were investing last time when we spoke over continue to invest, largely led by industries which see growth in their products and services.
All right, fine. New businesses, I've got to ask you this. Hydrogen electrolyzers, I think you've started the functioning of the first one. What's the ramp up there? And chip design, I believe you're in the hiring process. Again, what's the time to market there?
The product that we have manufactured, the 1 megawatt electrolyzer, has behaved well so far. We are putting it to extensive testing before we actually announce it to the markets. It stood the test well so far. So we do think in FY 24-25, we will begin to ramp up the production. We're also focusing on trying to increase the capacity from 1 megawatt to 4 megawatts. We are in discussion with our technology partners, and we expect to crack some developments during the course of the year. Insofar as chip design is concerned, I think we have marked our territories well. Time will tell as to how successful we are. But at the moment, we are trying to assemble a crack team, which will help us both design the chips as well as market them to the customers. India has a lot of talent on chip design, so we are counting on that talent to work for our brand.
Okay, let me finish up with a last question on hurdles or challenges. You've mentioned for the year gone by that logistics and supply chain is one of the big reasons for why your EBITDA was lower than anticipated. And you've also spoken to me in the past about not being able to find enough talent in India, though I do take cognizance of the fact that you've added about 10% to your engineering workforce. So can you talk us through both of those very quickly?
Yeah, sure, Menaka. I think the fact that we are constrained by both bandwidth as well as talent is getting addressed. And one of the reasons why our margins have also declined is we are investing some portion of our profits in building capability for delivering a huge order book that we have. Excess of $60 billion to be executed over the next 3.5, 4 years would mean that we would require skill set of a much larger magnitude and capability. So we are investing in the growth, and that does take about 20-30 basis points out of our margins. And secondly, with growing mix of international business, I think the cost of engaging workforce is also going up. And so consequently, the company is doing everything possible to take advantage of the opportunity ahead of us. And to me, that it would mean investing some portion of the profits. I think it's well worth investing.
So how much more do you hope to hire this fiscal year?
It all depends on the way execution pans out. There is no specific number in our mind, but I do think that we could possibly keep working anywhere between 5,000 to 6,000 people of different competencies.
All right, we're going to have to leave it there, Mr. Shankar Raman. Thank you for joining us this morning on Bloomberg TV. And with that, Paul, I'm going to hand it back to you.
All right, thanks so much, Menaka. We do have plenty more to come. Stay with us. This is Bloomberg.
Over 6 decades, Singapore has transformed itself from a colonial trading port to a buzzing financial center that's envied the world over.
Its GDP per capita itself has surpassed the likes of the UK, the US, France, and other developed countries.
And it's held up as an example for any country seeking to grow a robust, high-tech economy.
This is a wealthy economy with well-established institutions of good governance, efficiency, and long-term planning.
While Singapore has been an economic success, its leadership is criticized by some for the restrictions on civil liberties and the media. The buildup of wealth has brought problems of its own. Housing prices have increased, the cost of living has gone up. This is the Singapore that Lawrence Wong is inheriting as the country's new prime minister. So, whether it's managing discontent or guiding Singapore's continued evolution into a tech hub, Wong's job is to sustain the city-state's hard-earned success.
All right, that's our very own Avril Hong looking at Singapore's formula for success for Bloomberg Originals as Deputy Prime Minister Lawrence Wong prepares to take power. And we'll have special coverage of that historic leadership handover this week. All right, let's take a look at how we are tracking on markets at the moment. It's kind of a risk-off day around the region at the moment. We do have a few bright spots, though. Markets in Hong Kong particularly have recovered on that news that Bloomberg first reported, but has since been confirmed that China's government is going to auction off 1 trillion yuan of ultra-long special bond issuance. That's going to include 20, 30 and 50-year securities. So we did see something of a rally off the back of that news as well. All right, we've got some big interviews coming up that we want to tell you about. We're going to be hearing about the state of US-China relations and China's overcapacity issues as well from Treasury Secretary Janet Yellen. We'll also be speaking exclusively to French President Emmanuel Macron about trade, geopolitics and international investment. That's at 1 a.m. Tuesday, Hong Kong time. And we'll have an exclusive interview with Goldman Sachs Chairman and CEO David Solomon. He's going to be joining us from the Choose France Summit, which will be hosted by President Macron in Versailles. And that is it from Bloomberg Markets Asia. Horizons Middle East and Africa are up next. Stay tuned for that. This is Bloomberg.